Good morning. Welcome to America First Wealth Management Investment Outlook for January 21st, 2025. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. This is our standard disclaimer, which just simply states we're not recommending offering to sell or solicit to purchase or sell any securities. Any opinions are as of January 21st and are subject to change without notice. And I'll let you read the rest, but just to state, the viewers are free to make their own decisions and use this information in pursuit of their investment returns, and hopefully it'll be useful for people who tune in. What we like to do is start with our market outlook, and it's been a very busy week last week and certainly yesterday with markets being closed for the Martin Luther King holiday and the presidential inauguration. Certainly, if anything could be discerned from the inauguration yesterday, there's plenty of optimism for America as Trump becomes the 47th president. However, while we may be bullish for America, it is clear to us that the S&P valuation levels are high relative to history, and that has tended to not be a good indicator of stronger long-term returns. Trump tariffs threats may increase some market volatility, so we're watching those closely. Quite aware of that. Trump has threatened 25% trading tariffs with Canada and Mexico and 60% tariffs with China. So if he follows through on that threat, certainly will increase volatility, but we're watching that closely. Certainly numerous executive orders signed by Trump immediately after inauguration will have an impact on energy, consumer choice, and government accountability. The market will be digesting those and additional executive orders that are likely to happen. Last week, we saw a rally in both bonds and stocks, largely driven by the macro numbers. We had a cooler producer price index and core inflation numbers last week. So that reduced inflation concerns and hopefully puts us back on a track where the Fed will consider continuing their rate cuts. Also, something we're watching closely is now the LA fire damage estimates are now projected to exceed $250 billion, which makes it the most expensive catastrophe in U.S. history. The fires are about 60% contained now, but the Santa Ana winds are forecast to pick up considerably again this week, and we might be expecting those damages to increase even further. Key macro data points for this week. On Wednesday, we've got the 30-year mortgage rate in the morning. In the afternoon, we got the API crude oil stock change. Thursday, 8:30 a.m., initial jobless claims. 11 a.m., we've got the EIA crude oil and gasoline stocks change. And on Friday, 10 a.m., we have existing home sales. So kind of light in terms of macro data points. There are a lot of S&P 500 earnings reporting this week, which I'll be summarizing towards the end of the presentation. I highlighted this chart, I think about 2 weeks ago. This shows the S&P 500 forward PE level in the green bar, which is now currently a little under 23 times. And then the subsequent 10-year returns in history at this level, as you can see, have been near zero. So the 10-year returns that are projected based on historical forward PE levels and what happened in the past does not portend that the next 10 years will be very strong in terms of S&P 500 returns. That's not to say we won't have another good year or two in the markets. It's more likely that we'll have some correction at some point, and we don't know exactly when that's going to happen, but the long-term returns will obviously be impacted if there is a correction. I also pointed out this chart before. The top 10 names in the S&P 500 now account for 38% of total market cap. And historically, that's always coincided or portended a correction in the markets, and we're at levels that haven't been seen since the Great Depression. Another chart we pointed out previously was U.S. household allocations to stocks as a percentage of financial assets, are over 40% now. It's an all-time high, and it does cause us to raise the question, who are the marginal buyers to cause stock prices to continue to rise? If households are at the highest allocation in history, will they go even higher, or will they pull back at some point? These are valid questions that give us some concerns, valuation, investor allocation, household allocation, actually. And we have to raise these warning flags despite a very optimistic, hopeful outlook with the Trump being reinstated as president, as we saw yesterday. Turning to some of his policies, obviously the drill baby drill, we've been asked questions about whether or not that will really have an impact on inflation. And we decided to show you the chart of CPI inflation rate versus West Texas crude oil. And this goes back to January 1, 2016, about the start of the first Trump administration, to pretty much yesterday. And it's pretty clear there's a very strong correlation between oil prices and CPI rate. And it's likely that Trump and his administrators are quite aware of this correlation. And the decision, hopefully, to increase drilling in the U.S. will drive down oil prices. And if this historical correlation remains true, then we should see CPI dropping as well. Certainly the Trump tariffs that are looming are causing us to really focus on the direction of the dollar. This is DXY index, which has been quite strong since October. The dollar's gone straight up, and now it's broken down below the 10-day moving average. If tariffs are implemented, it will obviously have an impact on the dollar relative to other currencies. Likely that will drop, in our opinion. So that's something we need to watch carefully, because the strength of the dollar is obviously correlated to a lot of things, including inflation and prospects for companies to export or to import products. So it's obviously a very important indicator, and we're going to watch that very closely. Turning to weekly market stats ending last Friday. For the year to date, we can see all major indices are up, led, however, by the Dow Industrial Averages and the Russell 2000 small cap, as well as value stocks being number one. You see Russell 1000 value ETF being up the most, 3.43 year to date. So clearly a shift in market leadership towards value and small caps, whereas the NASDAQ and NASDAQ 100 are just over zero, 0.38% for NASDAQ 100 and 0.14 for NASDAQ. So as we all know, the NASDAQ indices are more tech heavy, so it's clear that the market is looking for new leadership as we are halfway into the beginning of the first month of the new year. So this broadening in breadth hopefully will continue, and that should be taken as a bullish indicator because obviously tech stocks and the Magnificent Seven stocks have driven most of the gains for the last 2 years or so. Turning to the Magnificent Seven names, we have 6 out of the 7 up year to date, with the only laggard being Apple, down 8.16%. Leading the pack is Tesla, up 5.61, and followed by Meta, second at 4.66%. Quite interesting to note, as I commented to a colleague, that quite interesting how two of the billionaire CEOs of these companies have now closely aligned themselves to supporting Trump, Elon Musk, and Mark Zuckerberg. And quite surprisingly, it might be a spurious correlation, but a correlation nevertheless. Those two stocks are up the most of the Magnificent Seven names year to date. And for the last week, we saw 5 of the 7 names up, just Apple and Meta being down. Apple seeing some struggles in growing their iPhone sales, reportedly in China. iPhone sales are down. So Apple's going to need to find some areas to reinvigorate their growth and hopefully innovate with some additional products that gain additional sales growth. So that's Magnificent Seven, by and large, still chugging away and showing strong results at the start of the year. Even though it's still tech heavy, the leaders are still tending to lead. Turning to the sector performance, for the last week, led by energy up 6.3%, and also leading for year to date up 9.69, followed by financials. So obviously the Trump policy trades with energy and financials benefiting from deregulation policy. Those are clearly 2 sectors that are jumping out into the lead here. At the bottom, however, is healthcare, as that's lagging pretty much on a weekly basis, and although positive, and not near the bottom for year to date. There are some questions about policy changes as the potential healthcare cabinet member RFK Jr. is being considered and evaluated for his nomination in the cabinet. It does raise a lot of questions about future healthcare regulation and policy and implication on companies in that sector. So it's still early in the year, but we can see certain sectors, certainly the value sectors, energy, financials, materials, industrials, jumping towards the lead last week and year to date. So I'm going to keep an eye on that. It is a healthy broadening and should support continued market advances, despite, as I called out, the overall overvaluation in the S&P 500 index. This is a chart we're probably going to stop posting, but I just thought I'd complete it since we're now through the inauguration. This is the S&P 500 since the election, November 5th, 2024, until last Friday, and the market has risen since Trump has won, with a fair amount of choppiness and gyration, which is likely, given the volatility around policy initiatives, executive action, and cabinet appointments and additional activities by the administration. But it's clear that the administration is moving quickly on a huge number of initiatives, moving quickly, hopefully efficiently, and we do expect them to run into some bottlenecks, as I'm sure the Democratic left-wing side of the government will announce or file a fair number of lawsuits against many, if not all, of the Trump policy initiatives, just to try to block and fight some of the previous administration's actions. For example, Trump has now, as I understand it, has reversed 78 executive actions that Biden had implemented. So usually executive actions have some sort of legal shielding around it to prevent the next administration from reversing them. So I'm certain that the Democratic lawyers will try to fight this in court. That may result in some delays of implementation of new executive actions, but we'll see how the courts handle it and whether or not it gets delayed or moved ahead quickly. Turning to the one-year S&P 500 index, we're now above the 10-day moving average, which, as I pointed out in the past, has been a good bullish indicator. The RSI, Relative Strength Index, below is neither overbought or oversold. It's kind of halfway in the middle, but turning up, which it usually does as the index turns up. But we're not in the overbought or oversold territory. It's likely that we'll continue to move up, at least in the near term. Certainly one factor that will impact the direction of the S&P 500 will be the current announcements from company earnings and outlooks, and we'll see what companies will be saying. This is a chart that our resident in-house technician, Jim Monahan, provided us. He pointed out previously the S&P 500 support 5861, which was briefly breached early last week, just prior to the PPI and CPI announcements. But the support, although it was breached in one day, by a one-day period, it turned around and rallied, and we're above that support currently. So this shows that that support's likely to continue to hold. We had thought that the second level support would be a potential level if this PPI and CPI numbers weren't strong, but fortunately they were favorable and the markets rallied. Turning to the 10-year Treasury yield, you can see the clear drop in yields last week after the PPI CPI numbers. For the week, 10-year Treasury yield dropped 16 basis points, closing at 4.61% on Friday. For the year to date now, 10-year yield is up slightly at 3 basis points. We have reached the 10-day moving average, which is a bullish indicator for rates, and hopefully they will continue to decline, which should support continued rallies in both bonds and stocks. Turning to the yield curve, we show the yield curve as of Friday, the week before, and the beginning of the year, December 31. You see a slight increase in the yield curve for the last week. We've dropped below the prior week of January 10th, but we're still slightly above the year to date. The good news is that the yield curve looks more normally sloped, rising versus inverted as it appeared for the last 2 years. So this bodes well for companies, namely financials, that are able to borrow short and lend longer. And it should be beneficial for financials as they continue their activities. Turning to the economic calendar, I won't go through all these in detail. As I mentioned on Wednesday, the 30-year mortgage rate and crude stock change numbers. We're looking for a draw of 2.6 million in API crude stock change. Given the cold front that we've experienced through the country, it might be possible that crude oil stocks could be lower than expected, which would result in a spike in oil prices. In terms of the 30-year mortgage rate, 7.09, we're expecting pretty much a minimal change in that, given we've seen 10-year rates pretty much rising until last week. Turning to macro data on Thursday, initial jobless claims will probably be the key number of the week, in our opinion. We're looking for 218,000 initial jobless claims. That's the consensus. Forecast is 219,000. Previous week was 217,000. So slight pickup in initial jobless claims. Some of that could be driven by the fires on the West Coast. But we're looking to see what the sources of those jobless claims are. And then we also have another crude oil stock data from EIA, looking for a draw of 1.961 million for the week. And also natural gas stock exchange, we look for a draw of 258 BCF. And again, natural gas will also be impacted by the colder weather. Turning to Friday, we have existing home sales as the key macro number. We do also have things like Michigan's consumer sentiment, which will be an important indicator of how consumers are feeling in terms of, and that has an impact on their prospective spending. And turning to S&P 500 earnings, there are quite a few. I won't go through all of them, but Tuesday we've got quite a few of them. 3M, Charles Schwab, D.R. Horton, Fifth Third Bank, KeyCorp, Progressive, Prologis, after close Capital One, Netflix, Seagate Tech, and United Airlines. I'll just leave this up for a moment so our viewers can look at the consensus versus a year ago, and also look at the consensus revenues that are being forecast. Wednesday, we have a pretty big slate of earnings as well. A mixed bag across industrials, drug companies, energy, and a couple of technology companies and insurance companies. I won't go through all these in detail. I'll just leave this up for a moment. We will be looking at these closely, obviously, for some indication of continual advance, especially among industrial companies, and would like to see how these companies are looking at their prospects for the year. And certainly given the new administration, any comments about how they feel the administration will help them or hurt them will be something we'll be focusing on carefully. And on Thursday, another nice list of companies: American Airlines, Elevance, Freeport McMoran, which is a key company in the copper mining space, GE Aerospace, McCormick, Northern Trust, Union Pacific, CSX, some rail companies there, Intuitive Surgical and Texas Instrument, Fair Isaac as well on Thursday. And closing out the week, we have American Express, HCA, NextEra Energy, and Verizon. So quite a busy week for earnings. We'll be paying attention to many of these and hopefully trying to glean some insights about how companies are going to be positioning themselves in terms of capital investment activity, and growth expenditures. And also we want to gauge the impact of AI on their businesses to see if companies are deploying the technology and where they feel it might be helping them in terms of growing their revenues or reducing their expenses, and or developing products to be used to enhance their revenues. So those would be areas of interest that we'll be looking at. And that's it for a weekly outlook. We are optimistic and bullish in the short term, but we do want to continue to point out that historically we are at high valuation levels, and while it can remain here and go slightly higher for a bit longer, we do feel that ultimately there is a moment of reckoning at some point, which could have a significant impact on long-term returns. So given the fact that short-term rates are still relatively high and there isn't a wave of economic bankruptcies or corporate bankruptcies to be concerned about, we do feel that it would be prudent, especially after the last 2 years of strong equity returns, to keep some dry powder. Allocation to stocks and bonds would be a prudent amount of level of diversification. We do suggest that investors deploy in their portfolios, but also given the broadening out of stocks into value and small caps, that does lend itself to being a bullish indicator for at least the short term. And investors should still remain, of course, be continually invested for the long term, but shift their allocations towards looking at other opportunities besides just riding out the Magnificent Seven and the tech sector, which had been outperforming for the last 2 years. So with that, to summarize, our summary is diversify assets and diversify equities. And thanks for tuning in. If any of our viewers or investors would like to get more information, learn about our products, or schedule a one-on-one call with us, please feel free to reach out to me directly. My email is listed below, or Jim Monahan, our COO, and his email is listed here as well. Thanks for tuning in. Have a great week, everyone, and we'll talk to you again next week.